Welcome back to CryptoPulse TV. This is day 8 of our 30-day crypto trading course. Today, you'll learn a concept used by banks and institutions to control price, imbalance, and fair value gaps. If you understand this, you'll stop chasing price and start trading like smart money. First things first. In trading, the market is usually in balance when buyers and sellers are evenly matched. Price moves smoothly, candles overlap nicely, and there's fair trading at every level. But sometimes, something happens like big news or institutional buying/selling, and one side overwhelms the other. Price shoots up or down super fast. This creates an imbalance. Think of it like a scale, normally balanced, but if you dump a huge weight on one side, it tips aggressively. That fast move leaves unfilled areas on the chart where little to no trading happened. These unfilled areas are inefficiencies in the price. The market doesn't like inefficiencies. It wants to be fair and efficient. So price often comes back later to fill or rebalance those areas. Imbalances are the footprint of smart money, big players pushing price aggressively. Now, the most common way we spot these imbalances on charts is through something called a fair value gap or FVG. It's super simple. An FVG is a specific 3-candle pattern. Here's how to identify it. Look for a big impulsive candle in the middle. This is the aggressive move creating the imbalance. Check the candle before it, candle 1, and the candle after it, candle 3. If the high of candle 1 is lower than the low of candle 3 for a bullish move, or the low of candle 1 is higher than the high of candle 3 for a bearish move, there's a gap in between. That gap is the fair value gap, the area where price skipped over without much trading. No fair value was established there. Bullish FVG forms on an upward impulsive move. The gap is below the current price. Price often retraces down to fill it, acting as support before continuing up. Bearish FVG forms on a downward impulsive move. The gap is above the current price. Price often retraces up to fill it, acting as resistance before continuing down. FVGs are also called imbalances, inefficiencies, or voids. In SMC, they're key because smart money creates them on purpose to accumulate or distribute positions efficiently. Smart money, banks, institutions don't want to pay bad prices. When they want to buy a ton, they push price down quickly to scare retail sellers, create a bullish FVG, then let price come back to the gap to buy cheaply. Same for selling. Push up aggressively, create bearish FVG, then sell into the retracement. FVGs act like magnets. Price tends to return to them at least 50 to 70% of the time to mitigate or fill the imbalance. Once filled, the original trend often resumes with strength. This gives us high probability setups. Wait for price to retrace into a fresh FVG in the direction of the trend, then enter with tight stops. Here's a dead simple FVG trading strategy. Identify the overall trend, higher highs/lows for uptrend. Spot a fresh FVG in the direction of the trend, bullish FVG in uptrend. Wait for price to retrace into the FVG zone, ideally 50% of the gap. Look for confirmation. Bullish candle rejection, pin bar, or break of structure. Enter the trade toward the trend. Stop loss below the FVG. Targets. Next liquidity level or previous high/low. Avoid old/mitigated FVGs. Once price closes fully through them, they're done. Pro tip: combine with order blocks or liquidity grabs for even better setups. Don't trade every FVG filter with higher time frame. Not all gaps fill immediately, be patient. Use on 15-minute plus charts for cleaner signals. Practice on demo first. That's it for day 8 of CryptoPulse TV. Now you understand how imbalance and fair value gaps control price movement. Comment day 8 completed if you're following the course, and get ready for day 9, where we reveal order blocks explained.